Welcome to our quarterly bulletin. My name is Methula Sikakana and I'm the Business Development Manager at Equilibrium Investment Management. Just some housekeeping. We applied for Continuous Professional Development or CPD points. It is important to please watch the full session and add your ID to the CPD section. This will help us to verify your attendance. You may also view this event on this platform at any time now until the end of November and receive your CPD points. Our operations team will email you the CPD certificates to you during December 2023. Please also feel free to ask any questions during the session. Our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the speaker tab on the top menu bar, or if you scroll down, you can also download the PDF presentation. Okay, let's kick off the session. First up is our economist, Sanisha Packirisamy, who will be highlighting the economic resilience shown in the global economy. Thank you for joining us today, Sanisha. Please take it away.
Hello everyone, and thank you for joining us today. In the wake of overlapping social and economic crises that created an enormous dislocation in markets, the economy made a much stronger and faster recovery than anticipated. Signs of progress have been undeniable as the world economy steadily emerges from the COVID-19 health crisis and Russia's incursion into Ukraine. Supply chain disruptions have largely normalized back to pre-pandemic levels. Global inflation pressures are easing, and labor markets are surprisingly strong. Economic activity and corporate earnings have proven far more resilient in the face of higher interest rates and rising living expenses. Markets have questioned the surprising resilience of the economy and labor markets given the sharpest pace of interest rate tightening that we have seen in more than 40 years. American economist and statistician Milton Friedman's long and variable lags theory partly explains why we have yet to see the full economic impact of prior interest rate hikes, given the traditional 12 to 18-month delay in the time it takes changes in monetary policy to affect aggregate demand. Although markets initially assumed the conventional lag would have shortened given the contraction in central bank balance sheets, this has not been the case. Secondly, pandemic savings pots have kept the economy afloat in spite of tighter policy. Outside of the United States, surplus household savings remain healthy and continue to provide support to ongoing economic recoveries. Finally, substantial fiscal support has differentiated the impact on growth in this tightening cycle. Project Syndicate calculates that close on $3 trillion in interest was paid on bank reserves since 2008, providing a significant channel of fiscal support to the private sector at a time when interest rates were rising. While the integrity of systemically important bank balance sheets and wholesale funding markets are healthier, historic precedent shows us that there is usually a delay in the reaction function of risky asset markets. As such, there is a non-negligible chance that the complacency penciled into global equity markets may yet be challenged. These relatively healthy economic conditions have given rise to the notion of a Goldilocks scenario, denoting not too hot and not too cold investing conditions. A few months ago, the market was preparing for more interest rate hikes and a well-telegraphed recession to prompt the start of a U.S. Federal Reserve easing cycle in the second half of this year already. However, since then, economic data releases have held up well. Jobs figures in the U.S., although slowing, remained bright, suggesting that the economy was relatively successful in stomaching the surge in interest rates since the start of the year. This left the consensus rapidly building up for a scenario of no more interest rate hikes and no recession at all. Nevertheless, announcements by Saudi Arabia and Russia that they would extend oil supply cuts and the devastating conflict between Israel and Palestine have reawakened concerns that inflation, though temporarily subdued, still lurks. An unsettling combination of rising oil prices, expectations of higher for longer interest rates in the US and Europe, and sluggish Chinese economic activity are stirring fears in financial markets. Although the year-to-date performance of the US equity market at face value may seem solid, closer inspection reveals that this can be attributed solely to a handful of large shares that shot the lights out. The share prices of the so-called Magnificent Seven grouping of Amazon, Apple, Alphabet, Meta, Microsoft, Nvidia, and Tesla were predominantly catapulted higher by the artificial intelligence hype this year. While this basket of 7 shares was up around 85% for the first 3 quarters of the year, the other 493 shares in the S&P 500 were down by a combined 10% in the year, leaving the overall index around 13% higher for that period. Such a narrow-based market advance brings the sustainability of ongoing equity market upside into question. As volatility in global fixed income markets have shown for some time now, there is a growing sense that global activity is losing momentum. With monetary policy working in long and variable lags, we are only starting to see the lagged effects of the 525 basis points of hikes already implemented in the US and United Kingdom and 450 basis points in the Eurozone at the time of filming. The expansion of central bank balance sheets through quantitative easing helped inflate asset prices in the past. So it is reasonable to expect that asset prices will face downward pressure as these balance sheets shrink. A tightening in global interest rates has brought monetary policy firmly into restrictive territory. This has increased households' and firms' interest payments. Moreover, consumers are seeking out more credit to supplement their income to support their rising living expenses. In the US, unlike other developed economies, excess savings from pandemic-related transfers are all but depleted, except for the top 20% of income earners who are keeping the economy afloat, or so says the latest Household Finances survey published by the Federal Reserve. Growth expectations for the US have softened, with consumers expected to contribute less to growth next year, given a reduction in savings, and a labor market which is slowing from a sprint to a more modest pace. The Bloomberg median consensus expectation for US growth next year slipped from 1.6% a year ago to 0.9%. Markets anticipate that growth should remain weak in Europe, as past inflation and interest rates bite further into economic activity. The Bloomberg median consensus projects that growth in the Eurozone will improve marginally from an expected 0.5% this year to 0.8% next year, the latter which has been revised lower from a projection of 1.8% a year ago. Contributing to the slowdown in global growth is the Chinese recovery, which has lost steam amid its post-pandemic reopening. Since the beginning of the year, the Bloomberg median consensus estimate on Chinese growth for 2023 has been scaled back from a peak of 5.7% at the start of the year to 5%, with next year's growth rate expected to slow to 4.5%. Additional downgrades are likely to follow suit, given tightened restrictions against China, sluggish demand in Europe, persistent weaknesses in the property sector, and subdued consumer confidence due to a lackluster performance in the equity market, as well as high youth unemployment. While the Chinese government reverted to familiar top-down stimulus measures, a more cautious approach was taken due to the concerns that the conventional levels of economic stimulus could exacerbate inefficiencies and disrupt the orderly deflation of debt bubbles in specific sectors. Despite policymakers' steadfast commitment to boost domestic sources of sustainable growth and reduce reliance on external demand, there has been a lag in policy implementation. Subdued inflationary pressures have become an additional source of worry regarding China's economic prospects in the recent months. Consumer prices experienced deflationary trends in July, sparking a comparison with Japan's deflationary spiral. However, core and services inflation, reflecting underlying trends, have consistently maintained a comfortable position in positive terrain. In our opinion, various factors mitigate the risk of China succumbing to a Japanese-style debt deflation scenario. In contrast to Japan in the 1990s, which was heavily reliant on the real estate sector, China has diversified its economic focus towards new energy markets and the digital economy. Japan's global export share plummeted from 8.5% in 1990 to only 3.5% in 2020, partly due to yen appreciation. In contrast, China commands a substantial 13% share of the global export market. During the 1990s, Japan experienced a significant surge in both equity and property prices. However, the ascent in China's asset prices has been far more gradual, suggesting that authorities still have a bit of leeway to deflate the bubble rather than witness a sudden burst. While Japan grappled with stimulating private sector lending in the 1990s, China possesses a state-owned financial system that ensures lending into the economy, averting systemic crises. The issue of China's aging population is a growing concern in financial markets. In 2021, 15% of China's population was 65 years or older, exceeding Japan's 13% in the early 1990s. Nonetheless, despite these demographics, a notable surplus of labor is still available in the Chinese economy, given the recorded 22% unemployment rate among the youth aged between 16 and 24. While China battles low inflation, much of the rest of the globe are still facing inflation rates in excess of central bank targets. Nevertheless, the likelihood of the major economies requiring significant rate hikes from here is lower, given the tangible evidence of earlier monetary policy tightening and given that the risks associated with inflation are currently more evenly poised. Though even if interest rates have yet to peak, future hikes should be less consequential for financial markets given the extent of rate tightening so far. That said, interest rate cuts are still seen to be some way off. Central banks are exercising caution in prematurely claiming victory in their efforts to rein in inflation. They are likely to sustain restrictive policies until inflation is consistently anchored closer to central bank targets. The Bank for International Settlements, or BIS, delves into the challenges confronting central banks in achieving the elusive last mile of disinflation. The BIS emphasizes that the latter stages of disinflation, characterized by positive but decelerating inflation, face hurdles such as waning base effects. Additionally, a late cycle surge in demand might ensue as real purchasing power improves amid slowing inflation and a rebound in nominal wages. Furthermore, mounting political pressure may compel central banks to ease interest rates as financial stresses start to accumulate over time. The initial surge in inflation triggered by supply chain disruptions, which appear to have subsided, has transformed supply chains into instruments of non-military leverage during political negotiations. Political trends and ideological differences are increasingly influencing global supply chain activity. Considering international relations between the world's two largest economies, the America First agenda, led by former President Donald Trump, accelerated the US's shift away from reliance on manufactured goods imports from China. Consequently, geopolitical relationships are now pivotal as nations strategically structure and diversify their supply chains. This is expected to significantly mold future trade and investment strategies on a more global scale. The expanding BRICS grouping, the African Union's inclusion into the G20, and a heightened focus on the global south underscore less developed and emerging nations' resolve to break free from Western influence and challenge the dominance of the US dollar. Nevertheless, Western powers remain influential, implying that nations need to adopt a more agile approach to foreign affairs. The emergence of geo-economic fragmentation, delineating the global economy into competing blocs, poses a significant threat to emerging and developing economies. These countries, highly dependent on a globally integrated economy, foreign direct investment, and technological transfers, are particularly vulnerable. Hence, fostering multilateral cooperation becomes imperative to mitigate these adverse effects. While none of this implies that an economic disaster is looming, the era of the Goldilocks economic environment is likely coming to a close. The uncertainty regarding the impact of tighter monetary policy, coupled with persistent inflation concerns, more recently due to renewed conflict in the Middle East, raises a critical question. Has the policy tightening executed thus far been adequate to smoothly steer inflation back towards the target? Continued cost pressures or renewed signs of rising inflation expectations may necessitate central banks to keep policy rates elevated for longer than anticipated, potentially exposing financial vulnerabilities and keeping debt burdens high. This raises the risk of additional volatility, particularly for lower-income countries that are already grappling with significant debt financing challenges. In today's interconnected world, maintaining open and well-functioning financial markets with resilient supply chains are pivotal for long-term prosperity across advanced and emerging economies alike. As such, international cooperative efforts are crucial in addressing the looming risk of geoeconomic fragmentation, which threatens to disrupt supply chains, food security, and the clean energy transition. In the short term, prioritizing efforts to rebuild fiscal space and ensure debt sustainability would conserve resources for future policy needs. Better alignment of fiscal and monetary policies should reduce the pressure on central bank authorities to manage aggregate demand and inflation. Establishing reinforced and credible medium-term fiscal frameworks alongside clear guidance on spending and tax plans would aid in addressing these challenges. Lastly, we need to revitalize structural policy initiatives in order to enhance growth opportunities. This involves reducing barriers in both labor and product markets while improving skills development, ultimately fostering investment, productivity, labor force engagement, and promoting more inclusive growth. I thank you for your time.
Thanks for sharing such great insights, Sanisha. Next up, we've got Nomatamsanga Khoza, a portfolio manager in Equilibrium. She will discuss how our local models are weathering through calm waters in volatile markets. Pleasure to have you join us today, Thami.
Thank you, Mutula, and good day, everyone. If you haven't yet done so, please download today's presentation and the quarterly report document by clicking on the Downloads tab at the top of the event platform. In sticking with the theme of calm waters in volatile markets, we start off with a perfect illustration of a beautiful sunset and an endless horizon. But the question you should be asking is, how deep are these waters? Well, let's find out. Earlier during the session, you received an extensive update on the markets from Sanisha. This is particularly important as it provides high-level context on how our portfolios have performed, as well as the underlying funds, which we will of course get to later on during this presentation. Let's look at a snapshot of our investment returns within our broader standard portfolios. You can see that the portfolios are ahead of their respective benchmarks over the 1- and 3-year time horizons. For the 4-, 5-, and 6-year periods, the portfolios are slightly behind their benchmarks over their respective time horizons, while outperforming their peer groups within the respective periods. We don't manage the portfolios in relation to the peer groups, but this is, of course, a very good sense check. The portfolios in the 7-year time horizon, namely the growth and the unconstrained growth portfolio, remain under pressure. This is mainly due to significantly higher CPI plus targets. So what were the key drivers of performance within our portfolios? This attribution table indicates that performance was primarily driven by our strategic asset allocation. Although tactical asset allocation detracted from performance, the results from our investment manager selection are quite pleasing, of course, barring the growth portfolio, where there was a slight detraction. We will now focus on contributions and detractors from total returns, and we will use the balanced portfolio as a proxy for today's discussion. You can see again from the slide that strategic asset allocation had a meaningful contribution to total return. This is important as it speaks to our long-term allocation to the various asset classes. In comparison to our expected returns, which is the black bars, most asset classes fared better over the last 12 months, barring South African bonds, which are still impacted by the lingering impacts of Lady Russiagate. Tactical asset allocation speaks to how we underweight, overweight, or take neutral positions on asset classes, depending on our short to medium-term views. You can see that the underweight position in global equity was the largest detractor from performance, as essentially and intuitively, we were underweight an asset class that performed relatively well. A noteworthy contributor to performance was our almost neutral position in global bonds. Let's see how our investment manager selection has fared. Similarly to what we saw in Q2 of this year, momentum enhanced yield contributed positively to performance due to a high allocation to floating rate notes in a market where short-term interest rates remain elevated. For its underweight exposure to consumer discretionary and precious metals contributed positively to performance as these sectors were hard hit, lingering, of course, from the previous quarter. Due to the ability to make sectoral tilts based on the macroeconomic backdrop, Fairtree's performance contributed meaningfully during the quarter. This was primarily driven by underweight positions in the consumer discretionary and property sectors. Visio's conservative bond positioning boasted well for this fund. If we then turn our eye to the detractors, Momentum Core Equity, which is our smart beta capability, underperformed mainly due to the quality factor. The underperformance in Momentum SA Flex was due to a high allocation to longer dated bonds as well as ultra longer dated bonds. And of course, again, going back to the sell-off that we did see in the markets earlier during this year, these bonds experienced a higher degree of a duration impact. Looking at the quality factor and Blue Alpha as a manager, this negatively impacted their performance during the quarter. Quite pleasingly, investment manager selection was positive across the conservative, stable, and moderate portfolios. You will recall, of course, that this is a demonstration of our skill in selecting suitable managers across our range of portfolios. Following in the same vein, there was a positive investment manager contribution in the balanced as well as the unconstrained growth portfolios, while noting the slight detraction in the growth portfolio. As I mentioned earlier, we make tactical asset allocation calls based on our short and medium-term asset class views. We haven't made any changes from the second to the third quarter of this year. Locally, we remain overweight South African bonds due to attractive bond yields and a more certain probability of achieving these returns. Although the macroeconomic backdrop is not favorable from a South African perspective, SA property and SA equity display attractive valuations, and we've therefore retained neutral as well as neutral to overweight positions respectively. Global cash is showing attractive yields, while bonds are pricing in a recession. We've maintained neutral positions to these two asset classes. Global equity remains a valuation story, and despite some market participants still anticipating very strong economic recoveries, there are still fears of a recession that are somewhat still looming. We therefore retain an underweight to neutral position. We are neutral on global property, although we note that the opportunity set is much more diverse and a global perspective relative to local property. This concludes our discussion for today. And in sticking with our theme of calm waters in volatile markets, I'd like to close off with a quote from Warren Buffett, a rather cheeky one that says, "Only when the tide goes out do you discover who's been swimming naked." It goes without saying that understanding and keeping track of asset classes through different market cycles is often quite complex. So we'd like to thank you for partnering with us so we can ensure that there is alignment between your advice process and the investment portfolios that our clients are invested in. Thank you very much for your time today, and I look forward to any questions that you may have.
Thank you very much, Thami. And now, Richard Stutley from our London office will discuss our global models and opportunities in the global environment. Welcome, Richard.
Welcome and many thanks for joining us for this portfolio update covering the third quarter of this year. Okay, jumping straight in, as this is only the second time we've recorded this video, I think it's worth very quickly recapping the range. There are 3 global US dollar denominated portfolios shown on this slide, and they're designed to meet certain global cash return outcomes in US dollar terms. They follow an outcome-based investment philosophy and are diversified across style, asset classes, and best of breed managers. As you can see, there's the cautious profile. We recommend a minimum holding period of 3 years for that solution. It has 30% in equities and a higher 62% in fixed paying investments, where there's that defined repayment from whoever you've lent your money to. That creates then a greater degree of certainty. Then we've got the managed portfolio with a recommended holding period of at least 5 years, 60% equities and a lower 33% in fixed income. Then finally, we have the growth portfolio, which is almost exclusively invested in equities, 90%. There's then a small amount in higher risk fixed income assets and 5% in property and infrastructure related investments. Okay, here's a little bit more detail on those portfolios. The cautious portfolio seeks to return 2.5% in excess of cash per annum over 3-year periods. So you hold it for 3 years, and we're aiming to deliver a return of cash plus 2.5% in dollars each year. In terms of the managed portfolio, the margin over cash we're targeting is 4%. And then finally, with the growth portfolio, we're targeting global cash plus 5.5% each year over a 7-year term. That's a pretty decent margin over what cash is paying you, obviously. How have returns been since we started running these Equilibrium models and other similar ones? Well, you can see here, looking at the green line at the top, first of all, it's ahead of its target, which is global cash plus 5.5% per annum, as shown in that corresponding dotted green line. And the same is true when you look at the other 2 portfolios. The blue line is the managed portfolio, and the cautious model portfolio is there at the bottom in red. That is obviously not to say there's not been a big sell-off in 2022. Last year was a very, very tough year for clients. Negative returns, as you know, they do arise from time to time, and then there tends to be a recovery. But when you're in the middle of a drawdown, it is obviously very painful. So we've highlighted 2022. In terms of 2023, which is that second shaded area, thankfully the lines are pointing in the right direction. But you can see that most recently, in terms of the last quarter, which we're going to focus on today, there has been a little bit of renewed weakness. That said, that kind of path we're seeing for 2023, with things drifting up, but with periodic setbacks, I'd say that's very typical of most investment profiles, i.e. things don't go up in a straight line. So it's still been a reasonable year this year, but there has been some weakness, and we're going to touch on that, more of that in a moment. Do remember this picture though, and I say that because when I look at it, what I see is that we're still only really just starting to emerge from the bottom of the performance profile created by that sell-off in 2022. Now, with government bond yields in the US close to 5%, as at the time I'm speaking today, return prospects look reasonable for a lot of global asset classes, and I think that's the context we need to think about. So markets have been resilient, as it says here in 2023, and that's the blue columns. Developed market equities have been doing very well on the far left-hand side, still up in excess of 10%. Emerging market equities doing okay, not very special, but at least in positive terms. And then over on the right-hand side, you'll see gold and newly commodities. They're also up for the year. More weakness clearly on that third blue column, which is the government bond index. Other parts of the fixed income spectrum doing somewhat better, but still down. That's inflation protected government bonds slightly down, the fourth column you can see there. Investment grade, EMD, essentially flat. This profile is not far from what we expected, and you'll have seen that reflected in our positioning this year, i.e. we stayed underweight government bonds, although we're now looking for opportunities to add, and indeed we have added a little bit more recently. Okay, if you then look at the third quarter, and that's the green columns, it's clearly a different picture. Pretty much all asset classes delivering negative returns with the exception of commodities. And when I think about that, there are certainly parallels with last year, but I don't think they should be overstated. In 2022, pretty much all asset classes were down while commodities were up. But that goes back, obviously, to Russia's invasion of Ukraine, which turbocharged many key commodity prices, thus putting huge pressure on inflation and subsequently asset prices. This time around, we've seen a little bit of that, yes. Oil prices moved during that Q3 back towards $100 per barrel. As I speak now, they're closer to the $90 per barrel range. But what Q3 was really about is a further move up in interest rates, largely unrelated to commodity prices, and more instead reflecting the strength of several key economies. Hopefully you've seen a video of me recently saying we thought interest rates would continue to go up. Hence, we're not overly surprised by these latest moves, even if we're clearly never happy to see negative returns. In terms of that economic strength, the line that really matters on this chart is the dark blue line, which is the USA. This chart is picking up how incoming data looks compared to expectations. And on the whole, data has surprised to the upside in the US, i.e. the US has been surprisingly resilient, as the chart title says. Have there been areas of weakness? Well, look at the red line and the lighter blue line, and that's the Eurozone and China. Between them, however, those two areas only account for around 20% of global developed market capitalization. The biggest part of what we invest in, instead, is those lines that have been good, the USA and, to a lesser extent, the UK. Between them, they account for more like 70% of global market capitalization. So that's why we say here, in terms of what matters, the incoming data on economies has been pretty positive, actually. Strong incoming data is, however, a double-edged sword, insofar as it raises questions about what it will take in order to bring inflation back down. If you look at the dark green line on this chart, that's producer prices. So absolutely, companies are no longer seeing strong rises in input prices, which is good news. The rest of the lines, including the dark blue, which is headline inflation, are all moving in the right direction, but only slowly. And you can see that we're still in the region of 5% inflation, there or thereabouts, whereas we need to get back to between 2 and 3%. That is the optimal rate for economic growth. So there's still work to be done, and the view that interest rates would start to come down very quickly as early as this year, that's proven to be incorrect, increasingly so as we've gone through 2023. Okay, that effect is shown in this chart, which I've shown before a number of times. This shows how market expectations of year-end interest rates has changed as we've gone through the year. Expectations started the year reasonably high, then they fell sharply after we had the regional banking crisis in the US in February. Since then, they've been steadily moving higher, and we're now above where we were at the start of the year. Moving on then to returns. The first column showcases last quarter's returns, and we can see the short-term weakness I referred to earlier. Cautious return -3% over the quarter, managed -3.7%, and growth -4.1%. And then next we've got the two key reference rates that I think we always need to be paying attention to. That's how we're looking compared to our return targets and also how we're doing versus peers. It's all very well to outperform our return targets, but if we're underperforming peers, then that's not good enough. So what you can see is last quarter's returns were weak and therefore behind our cash plus targets, which are almost always slightly positive. And indeed, they've been slightly behind the peer groups. The margin of underperformance versus peers is 40 basis points for cautious, 60 basis points for managed, and 100 basis points or 1% for growth. So a disappointing quarter, both in terms of returns, i.e. we don't want to be delivering negative returns, and in terms of how we have performed relative to peers. But I would say, if we look at returns over 1 year, you can really see how we're starting to repair some of the longer term numbers, and that is virtue of very good returns over 12 months, both versus our targets and versus peers. So despite that weakness last quarter, the cautious model is still 2% ahead of peers over 12 months, managed is 3.3% ahead of peers over the same time period, and growth is further ahead, around 6% ahead of the peer group median. So we need to reflect on this latest 3-month period, which we'll do now, but it is pleasing to see those 12-month returns. So here's a simplified illustration of the key contributors and detractors last quarter. And you can see at the top there what worked was fixed income positioning, particularly within the cautious profile, and that was to continue to be underweight duration. You had government bonds down approximately 4% last quarter, so clearly you wanted to own less of those and more cash instead, and that's precisely what we did. Fixed income managed selection was good as well, and you'll see on the next slide that Dodge and Cox continued to do a decent job last quarter, even though they were down by much less than the 4% loss for global government bonds I mentioned a moment ago. In terms of detractors, the biggest one was our commodity exposure. We don't have wide commodity exposure. For example, we don't target things like agricultural commodities, but we do allocate to gold. We think it's a great diversifier. That didn't come through last quarter, but we saw on the earlier slide how gold's actually done pretty well year to date and much better than bonds, which continues a theme from 2022. So it's worked really nicely for us during this period of weak markets that began in 2022, and we have to accept that you do from time to time get weak quarters, and that's nothing I'm particularly concerned about. Our real assets exposure was also weak. We don't, again, have a lot in property, but parts of the property universe are clearly under huge amounts of pressure, in particular things like offices. Increasingly, that tough operating environment is reflected in prices. And remember, you don't need to buy businesses with a great growth trajectory. You need to buy businesses where the price you pay is way below the reality of what profits for that business are going to be. And that time will come for property. So we're happy to hold on to those positions in the expectation that they'll do much better in future periods. Finally, equity manager selection was also weak, as we'll see in the next slide, particularly within EM, where our managers were a bit weak, but that comes on the back of decent returns over 12 months. So here are all the returns in a bit more detail. When it comes to our developed market equity exposure, we get all of that through the Momentum Global Equity Fund, which, remember, is a multi-manager fund. It's got 14 underlying sub-investment managers. Taken together, that blend of managers was down by 3.7%, very much in line with developed markets last quarter. When it comes to our emerging market exposure, our managers all underperformed by around 2% versus the MSCI Emerging Markets Index. That said, if we look at Coronation over 12 months, they've done a very good job for us. There's nothing in there that is particularly concerning on the bond side. I mentioned Dodge and Cox down only 1.8% when global bonds are down close to 4%. They're also up 9.1% over 12 months, which is a huge margin of outperformance, and hence they've been a significant contributor to our good returns. Stanley were weaker last quarter, but again, if you look over 1 year, they are way ahead of the global government bond index and thus doing a decent job. Last quarter was a time to hide in cash and very short-term bonds, hence no surprise that Coronation Global Strategic Income and 91 US dollar money market fund were our best performing positions last quarter. You can see then the two key detractors, the gold strategy, again run by 91, and then the Catalyst Global Property strategy, which was down 7.3%. In terms of the gold fund, I've mentioned before that this strategy invests in physical gold, but also in the shares of miners. Share prices tend to react in a bigger way to moves in the underlying commodity prices, and that's what we saw last quarter. I said it a moment ago, we're very happy with that position. It's up 14% over 1 year, despite that weakness in the last quarter. Now, what's been going on in the portfolios? The key changes were earlier this year in Q1 when we completed the transition to our new equity implementation, which comes through the Momentum Global Equity Fund. That gives investors access to the best equity managers from around the world, ones that either aren't available elsewhere in South Africa or indeed aren't available other than to institutional investors, i.e. they don't run funds for small investors. So it's a great way to access what we, as I say, think are the best managers in the world. And then more recently, on the bond side, with bond yields moving up, it was time to add a bit more bond exposure in the cautious portfolio. That's proven to be early because yields have continued to move up, but incrementally, as those yields move up, we want to be adding, and that's precisely what we've been doing. In terms of our outlook on asset classes, and remember this is building in our understanding of things like economics, which Sanisha spoke about earlier, and our understanding of market dynamics and a wide range of factors. Taking that together within fixed income, we're neutral, and that's probably edging up to actually an overweight because yields are increasingly attractive day by day. Alternatives, we continue to really like because you need to have diversifiers in the portfolio at a time when equities and bonds are still reasonably correlated. That's coming down, as we'll see in a minute, but it's still the case. That diversifier for us is predominantly gold, which, as I mentioned previously, has done a good job, certainly over 12 months. And then there's cash offering decent yields alongside falling inflation, and hence we're pretty happy to hold some of that. I'm going to expand on the bond story in the last few slides, and we start here with the red line, that is the 10-year Treasury yield, and you can see how far that has moved from the lows of less than 1% in 2020 up to now where it's close to 5%. So that's what's happened to the yield available on essentially risk-free investments. And if we contrast that with what's been going on with equities and the earnings yield those companies produce, how much earnings they throw off, that yield hasn't done a huge amount. Now, we would have expected it to move up more, and therefore the additional compensation for moving out of lending to the US government, i.e. buying treasuries, and instead giving our money to these companies, buying their common equity, that's shrunk materially, and it doesn't look sufficient in our view, and hence that's why we're underweight equities today. We're in a completely different world today compared to where we've been for much of the past decade, and so it's particularly important now not to imagine building your portfolio based on the recent past. I.e., yes, absolutely, bonds have been very weak, but think now they are offering really good yields. I'd use this example. If someone offers to sell you a car at half the price it was on sale for a year ago, I'm not saying definitely buy the car, take a look, but I am saying I think you're more likely to be buying that car today than you are to be selling your own car at 50% of what you probably thought it was worth a year ago. Point being, don't dump bonds just because of how poorly they've done recently. Rising interest rates, as you know, caused the sell-off last year. As the return on cash went up, returns on all other investments had to go up in unison. Therefore, you saw this huge positive correlation between equities and bonds that I mentioned previously. What this chart shows by plotting that correlation through time is just how unusual a year like 2022 was. Normally, bonds and equities do different things, and therefore, yes, 100% bonds didn't do what you'd expect last year, but that doesn't mean don't own them this year. Another way of showing that same story about how equities and bonds tend to interact is looking here at periods of equity market weakness going back to the end of the Second World War. Now at the top there in red, that shows every time equities have fallen by 10%. And what you tend to get, just as equities draw down, is bonds drawing up. So at the bottom there in yellow, every time there's a spike down with the red line, the yellow line spikes up. And that's bonds doing what we all expect them to do, which is to offset the equity returns. Now, fast forward to last year, that didn't happen. It didn't happen because we're in this period of ultra low interest rates, as shown by the green lines, and hence bonds fell at the same time as equities. That point is really brought to life with this final slide in this section. The thinner green line you can see there, that's showing you where yields would have to go at each point in time in order for bonds to give you that positive return of 10% and thus offset equities. And during the period when yields were very low, they would have had to have fallen even further to levels that make no real economic sense, i.e. they would have had to gone deeply negative. So we were in this period where bonds couldn't really deliver an outsized positive return to offset the weakness in equity markets. But fast forward, we've moved to a period where if equities start to fall, there is that scope to cut interest rates, meaning bonds can offset equities. Therefore, again, the real takeaway from this section is that we're in a very different world today. Here, quick roundup of the major macroeconomic factors in terms of inflation and monetary policy. Inflation is moving the right way, but it's going to take time, and we therefore need higher interest rates for longer. In terms of the economic outlook, there is a slowdown in growth underway, and we can't really see the conditions for a sudden surge in growth, I'm afraid. But that said, we're not expecting a particularly poor period for growth, more of a muddle through scenario. And those kind of thoughts and assumptions, they feed through into our thinking about businesses and where to put money today. In terms of risks, there are many, there always are, but the key one is that we get an unforeseen financial accident due to the pace and extent of interest rate rises. Offsetting that is the fact that household and corporate balance sheets are still in reasonable shape. Yes, they're running down savings, but they're still in reasonable shape. And that means shocks can be absorbed, much like we saw with the regional banking crisis in the US and to an extent Europe earlier this year. When we talk about a better year in prospect, it comes back to the starting point that when you've got treasuries, and be it the 2-year or indeed the 10-year, all yielding around 5%, that is a really good underpin for returns. So we're in this higher return world, absolutely. There's going to be bouts of volatility. I suspect we may be in one by the time this video goes out, but asset classes are all offering decent prospective yields, and that will ultimately come through over time. One final slide then, just to underline the fact that inflation is painful. It's been extremely painful when you think about last year, but as this chart shows, once inflation peaks, returns, certainly in the past, have tended to be pretty good for the 5 years thereafter. So I will leave you with that thought. Thank you very much for your audience.
Next is Paul Nixon, our head of behavioral finance, who will discuss investor behavior for 2023 in respect of switch activity and the behavioral patterns that destroy the most value. Over to you, Paul.
Thank you, Matula. The world is at an interesting juncture. On the one hand, looking towards the future, artificial intelligence, and just how closely we can get AI to mimic human behavior and empathy. On the other hand, we're looking at things like lifestyle dividends, working from home, the possibility of a 4-day work week, and how resilient the humanities will be to artificial intelligence. As psychology becomes part of the CFP syllabus, the industry is grappling with just how much of a threat AI will pose to financial planning. The question is perhaps not if AI can replace advice, it can, but will it? The Gell-Mann effect is a term coined by famous author Michael Crichton, where humans tend to be less trusting of content where they have some domain knowledge or experience. This is why when you punch a destination into your navigation app and it gives you a route, sometimes you're like, really? This can't be right. It must be faulty. Surely the route I was thinking of is better. This is usually followed by regret, but it's probably because you have a lot of knowledge and experience about driving and route planning, and perhaps your navigation app has let you down once in like 100 times. I can see this playing out exactly in the same way, though, where AI is recommending stocks. We are more likely to remember bad picks by the AI much more than the good picks, which, if you're tracking your portfolio and building knowledge and experience, will result in this Gell-Mann effect kicking in. After an AI stock recommendation, I can just imagine a human arguing with the AI in exactly the same way we did with our navigation systems. Really? Richemont? That can't be right. Are people still buying Rolexes? I'm going to go with Sasol. We're on the wave of another economic recovery, right? One driverless car accident causes an uproar where a million human-led fatalities don't. One thing that is clear is that COVID has shaken things up a bit and changed the structure of investor behavior, and that's what we're going to be talking about today. These are the highlights of investor behavior for the 2023 period in our latest Sci-Fi report that is available for download under the Downloads tab. In summary, the behavior tax is back with a vengeance at near COVID levels and confirms once again that it's so important to outsource investment decision-making to your DFM, where they have shown to systematically add value in rebalancing and manager selection processes, for example. Rebalancing is a great way to force investors to sell high and buy low, instead of the other way around, which is behavior that has persisted since COVID and is still destroying a lot of value. In the 2022 period, we titled the Sci-Fi report as Behavior Tax Loading. This is because the previous report cuts off at September 2022, where the market had just dipped below 65,000 points. This was paired with sharp risk-off behavior as investors moved to the cash side of the risk spectrum during the market downturn. In essence, this means these same investors are stuck in the wrong place at the right time when markets start breaking records in January of 2023. Overall, the behavior tax was negative for 2022. For the assertive investor, wasn't penalized, however, for chasing past performance of 2021. For example, those assertive investors that switched into property in 2022 with the hope of repeating the returns from the property recovery in 2021 ended up being heavily disappointed. This is also important as for the first time we saw that even though 2022 was an overall negative behavior tax year, there was still a pattern of behavior, the assertive investors, that destroyed value a lot of the time. More about this later as we begin to use machine learning to predict switch behavior. The negative behavior tax for 2022 quickly reverses as markets recover later in 2022 and then start dipping. Switching starts to result in locking in losses and moving to funds that ultimately would deliver a low return after the recovery, as we mentioned, followed once again by declining investment returns. If investors had just remained closer to the fixed income side of the equation where they moved to the year before, the behavior tax certainly would have been much lower. Market records, however, are very hard to ignore for investors. This is also clear in the next slide, which we'll talk about shortly. Overall, for the 2023 period, which is calculated from the 1st of October 2022 until mid-September this year, the behavior tax is 4.02% in FIOs, or the flexible investment option, and 3.27% in Rios, or the retirement income option. The total value destroyed is just over 110 million rand, with 65% of this value eroded being from behavior in living annuities, which is obviously concerning, as 75% of the behavior tax, nearing 500 million rand during COVID, was also in living annuities, or Rios. This is obviously concerning as people in retirement are destroying more value. There is definitely a great place here for the gap product that allows the combination of a fixed and living annuity that will likely give many clients better retirement outcomes. We can see a clear performance chasing trend timed very well with surging markets later in 2022 that quickly reverses as markets start to take a downward trend in 2023 and people start to de-risk their portfolios once more. The mountain on the left representing greed from chasing high levels of past performance initially, and up-risking portfolios happens in time with the market upturn. This is followed by fear as the reversal happens and markets tend downwards rather in 2023, as we saw on the previous slide. Before we examine which archetypes performed better and worse for the year, we take a look at the funds investors left in search of greener pastures during this process. This table shows one of the main ways a behavior tax is created. In descending order, so least to most, the funds with the biggest outflows for the period are shown. Importantly, the 12-month past performance is shown, and then the 12 months of investment performance is shown where possible. In other words, future performance. If we don't have a full 12-month future performance, the shorter period performance is annualized for comparison purposes. Note the 2023 period is once again from the 1st of October 2022 to mid-September 2023. The exact performance numbers are less important rather than the trend. The table shows in essence what investors often miss out on when they switch out of funds that have not lived up to their expectations. In each of the top 10 funds switch out of, the future performance is greater and the margin is between approximately 3% and 25% in future performance sacrificed. Consider the Coronation Balanced Defensive and Balanced Plus funds together with the Forward Flexible Funder funds. 280 million rand in outflows left these funds from a 2022 performance period, resulting, or likely rather, as a result of performance between 0.1% and 3% that didn't live up to investor expectations. This is followed by positive returns of between 13% and 15% respectively. Note that these are net outflows for the period, and so the brief market upturn attracted a lot of risk-on flows, but the overall trend was still risk-off for the period. This is confirmed by examining the top fund inflows for the period that have cash and cash plus return profiles respectively. The behavior tax for the 2023 period is once again relatively high, the highest since COVID in 2020 in fact. It also appears that a clear BC or before COVID and AC after COVID environment has materialized. The behavior gap or behavior tax on average is significantly higher since the global pandemic. The market timers are now 34% of the population and are comfortably the biggest archetype. The market timer is greedy when others are greedy and fearful when others are fearful. In a choppy market where there are more frequent ups and downs, we'll always see that the market timer destroys the most amount of value, as switching behavior often erodes value on each of these behaviors. On average, market timers again switch at a very high rate, double that of the assertive investor and 60% higher than the anxious investor. We can also see that the assertive investor once again destroys nearly 4.5% on average per switch. They were the only archetype to destroy value last year, where the overall behavior tax was negative, as we mentioned earlier. This was because of up-risking and chasing past performance in a declining market just destroys more value. We can also see the assertive investor switching the most infrequently for the year, but overall destroying by far the most amount of value per switch. Also interesting is that the avoider archetype switches more frequently this year, and for the first time occurs a behavior tax of over 2%. This is a general trend in behavioral patterns that is quite interesting. If we look at this a bit closer, we can see a clear upward trend in the market timer archetype since the onset of COVID. It appears that this rise is at the expense of the assertive investor. More investors are becoming more uncertain and so abandoning their investment strategy as markets have tended to become more unpredictable. Research we conducted in 2021 showed that investors are about 9 times more likely to execute an investment switch when they experience a return of less than 12%. This may explain why switching activity has increased so much as investors are adjusting their expectations because of local market returns, not being what they used to be. This is also playing out in the changing proportion of archetype behaviors as investors are trying to get in quickly as markets surge and avoid any downturns. This has resulted in value destruction overall, however. What is becoming more apparent is that we are seeing some stability in the new normal of behavior tax levels. There is consistency between the behavioral pattern and value destroyed in 3 of the last 4 periods analyzed. The market timer usually ranks number 1 in behavior tax, and once again, market timers are usually penalized most heavily in up and down markets. Consistently, the archetype with the least behavior tax is the avoider, who generally takes less risk and also moves between low-risk portfolios. They're invested in more stable or less volatile portfolios in general, and so the cliff is much lower for them to fall from when compared to the assertive investor, for example. It is always important to remember, however, that avoiders likely pay an additional behavior tax from investing too conservatively over a lengthy period that could make inflation a bigger threat to their wealth when compared to the other archetypes. The assertive investors regularly rank second, even though they usually switch the least together with the avoider. In 2022, they were the only archetype to erode value from switching when the remaining archetypes had a negative behavior tax, as we mentioned earlier. In this case, the anxious investor who de-risked faster added the most amount of value from switching. The market timer, who is in essence a combination of the assertive and anxious investors, added the second most value from switching in 2022. They benefited from de-risking more quickly, but lost out on the up-risking piece of the equation together with the assertive investors. It is important to note, however, that every rand in value added from the anxious investor switches last year has in fact reversed for an overall erosion in value over the past 2 periods. Another issue here is that we have shown in general people tend to stick to their archetype or behavioral pattern around 70% of the time. On 30% of occasions, investors are drawn to other patterns of behavior, meaning that most of the time, most switching investors will experience something closer to the average behavior tax of 3.39% over the past 4 periods. That is since the onset of COVID. The 3.39% average is well above previous behavior tax levels in market crunches like the global financial crisis, and in fact has persisted. This means that it's become more dangerous to switch in recent times, and once again reiterates the value of a DFM that gives your clients the best chances of reaching an investment outcome, strategically rebalancing back to long-term asset allocation. I'll be presenting at the Association of Computer Machinery AI in Finance conference shortly, taking place in New York City, on machine learning to predict behavior. One of the biggest advantages of supervised machine learning algorithms is that they can identify important behavioral features based on multiple samples from a large data set using different combinations of features to answer the important question of how important is each of these features to investor switching behavior. You can see on your screens how important is each of these features to investor switching behavior. You can see on your screens the 3 most important predictors of switching uncovered by the algorithm based on analyzing over 12 million observations. An observation in this case is both switch or don't switch. Firstly, we have risk preferences. The older your client is, the greater the number of unit trust funds they have in their portfolio, and the more money they have, the more likely they are to switch. During the COVID period, we saw that 75% of the behavior tax was incurred in the retirement income option, or RIOs, as we mentioned earlier. This year, we can see it's approximately 65%. Secondly, the belief system is important. We continually formulate beliefs on the way the world works and update our belief system based on feedback. So the win, stay, lose, move belief system appears to be the way many investors make sense of this complex decision. Here we can see that the higher your past switch value, together with the more switches you've done, And the more you've made that decision based on 12-month performance, the more likely you will be in future to switch again. There is a link here to advisors, unfortunately. It is likely that the only time investors see 12-month performance is during the annual review process. This means that the annual review meeting with clients holding relatively larger portfolios that are likely justifying more contact are indeed an important determinant of the switching decision. Finally, we see risk perception as being very important as well. Both relative performance versus other funds and absolute performance, or the performance distance from zero, are important predictors of switching behavior. These are important reasons that advisors should be using DFM solutions that take much of this guesswork away from advisors. Back to the machine learning algorithm though, using random forests, we are now able to reliably predict an investor switch in the next 60 days or 90 days, giving sufficient time for an intervention to occur and ultimately to reduce this behavior tax. Interestingly, the insights from supervised machine learning also show the market timer archetype is having a significantly greater likelihood of switching. In this case, both forms of machine learning are uncovering the same insights from different angles. Another lens to look at this behavior through is with psychology. Two personality traits that map extremely well to financial behavior are conscientiousness and neuroticism. Conscientiousness reveals our preference for now over later. It also reveals whether you're more casual and relaxed or prefer more deliberate and ordered or planning behavior. Would we prefer to eat the marshmallow now or instead wait to get another one? Neuroticism is all about our activation of fight or flight. How anxious versus composed are we? Combining these show that there are some of us with excellent factory settings for good investment behavior, those with high C and low N. Then in the opposite corner are those of us that sit in the danger zone with a preference for now, together with being more present-oriented as well as being anxious and impulsive. Of course, the other two quadrants are also possibilities, and each quadrant would carry different behavioral science strategies to try and change that behavior. For example, people in the danger zone need what is called commitment devices. The first thing you do when you go on a diet is you tell everyone. Why? Because your brain won't like actions that are dissonant with your words. This is called cognitive dissonance. Simply put, you'll be less likely to appear with a chocolate in front of people, particularly those you respect, whom you've told that you're dieting. This is just a very simple example of the kinds of insights we'll start generating when we collect personality and money attitude data from our money fingerprint psychometric assessment. I look forward to sharing some of these insights with you all in future. Ultimately, behavioral finance is all about securing better investment outcomes. It's about getting people invested, getting them to save and invest more, to invest differently in DFMs, for example, and finally, most importantly, to keep them invested and to avoid paying a behavior tax. Until next time.
I will now hand over to Flobela Yates, the head of Equilibrium Investment Management, who will do a summary and closing of the session.
Thank you, Matula. Phew. Every quarter I find myself considering the volatility, and every quarter I hope that next quarter will be less volatile, but it isn't. When we construct portfolios, we focus on constructing the portfolios for a specific time horizon, and so we are long-term investors. Our strategic asset allocation is set, and it is the main driver of returns. So we do make adjustments for short-term blips, but only when there are opportunities. For example, if we see that there's a misprice in the market and gives us an opportunity to either upweight or downweight an asset class. But those are small marginal moves at the margin. They are not the long-term drivers of return. And so, although the strategic asset allocation is set for the foreseeable long-term, medium and long-term future, we do obviously not keep it static, and we do readjust and make assumptions every quarter. What we can't do is predict all the volatility and incidents that happen. So whether it's interest rates, Russiagate, potential recessions, or more recently, the war in Israel, we keep an eye on it, but that doesn't mean that we make huge changes to your investment portfolio. We are here to get your clients to their investment outcomes, and we are dedicated to doing that. We actively manage the portfolios. Thank you for trusting us to look after your clients' money and to show the best that we can in our fiduciary responsibility to get them to their investment outcomes.
Thank you very much, Flo. Just as a reminder, please watch the full session and add your ID number to the CPD section so we can verify your attendance. You may also view this event on this platform at any time until the end of November and receive your CPD points. Thank you very much for joining us today. We hope you found this webinar insightful.